So good morning, everyone, and thank you for joining us. And of course, the Connecticut Small Business Development team. We're very excited that they could be here this morning, and we appreciate the fact that we had to roll it over another week, but I know they're ready and willing to answer all your questions today. As you know, you guys are on board and will be muted as participants, but if you notice at the bottom, there is the question and answer and the chat button functions. So please click on those and ask your questions. My colleague Jeff and I at the end will tag team and do those questions for you. For those of you who are calling on the phone, you can just send an email over to myself, Johanna@middlesexchamber.com. That's Johanna @middlesexchamber.com with any questions you may have. I'd like to turn it over to our great leader, Mr. Larry McHugh. Hold on, Larry, you're muted.
Okay, first of all, before starting, again, I want to thank the Connecticut Small Business Development Center for not only these workshops they've been running, but more important, over the years, their wonderful support of our chamber through, in the case now, Jim Jackson doing a fantastic job dealing with businesses. But this has been a relationship that I have cherished over many, many years. Just to give you a quick update, we heard yesterday, June 11th, we'll have Governor Lamont and David Lehman. That will be on a noon virtual luncheon, which I think will be very important. That's a good date for us as they get close to the June 20th date. People will be able to go online and register for that. And in mid-July, we'll be having another virtual function, which will be another luncheon, and that will be with Ed Liu, President and CEO of Jackson Labs from Maine, will be calling in. The amazing thing about that is that not only his unbelievable leadership of Jackson Labs, but during the SARS problem on Singapore, he was the lead person on that. So I think that there will be some very interesting Q&A at that. It gives me a great honor now to introduce Matt Pugliese, who I've known for many, many years and has always done an outstanding job. He's the Associate Director. And Valeria and Jim, I want to thank both of you for being on with us today. And again, Matt, thanks for all your great support. Looking forward to this. I have to get off into another Zoom call, but Jeff and Johanna will be handling it. And again, a sincere thanks for all you guys, everything you're doing for all the citizens of the state of Connecticut. Thank you.
You're welcome, Larry. Thank you so much for your support. Larry, Jeff, Johanna, you're all doing a great job supporting small businesses in Middlesex County. You always are, but especially over the last several months in this really trying time. So thank you, and thank you for helping coordinate this effort to reach out to all of you that are here today to learn about Paycheck Protection Program forgiveness. I'm Matt Pugliese. I'm the Associate State Director of the Connecticut Small Business Development Center, and I'm joined by my colleagues Jim Jackson, the business advisor that serves Middlesex County, and Valeria Biscelli, our training and learning advisor. The Connecticut Small Business Development Center is funded through a cooperative agreement with the U.S. Small Business Administration, the Connecticut Department of Economic and Community Development, and the Yukon School of Business. And we're going to go through this information on PPP forgiveness today, but if you have questions that we don't get to or you need additional guidance, our team will be glad to help you move through this process. So please, you can reach out and register for free advising services. No cost, strictly confidential, and we're available both in trying times like this and in normal times to help you move your business forward. So Jim, we can go to the next slide. So we're going to start off the overview today. We're going to go through what remains the same with the PPP forgiveness that was outlined when the CARES Act first formed the program, and then go through what adjustments have been made, and then take your questions at the end. So there have been several adjustments made since the CARES Act first passed at the end of March. And as Johanna said, we delayed this presentation by a week, hoping to have final guidance in our hands so that we could provide you with the most complete guidance possible. The interim final guidance was issued last weekend, and we're going to walk through this now. There is, first off, something that was not available when they first launched the program. There's now a PPP forgiveness application form that's been released by the SBA. So that is the formal document that you'll need to complete as part of the application process. So what has remained the same? The allowed uses, qualifying payroll expenses, including health and leave benefits, payments on mortgage interest, not principal, rent and utilities incurred prior to February 15th, 2020. And still, in order to qualify for the loan forgiveness, at least 75% of the loan must be used on payroll. And what are these payroll costs? They include salary, wages, commissions, similar compensation, cash tips or equivalent. It can include the payment of vacation, parental, family, medical, or sick leave. It includes the allowance for separation or dismissal of an employee, payment benefits such as group health coverage, including insurance premiums and retirement, payments of any assessed compensation on employees, and for independent contractors or sole proprietors, wages, commissions, income, or net earnings from self-employment. Employee total compensation eligible for forgiveness cannot be over 100,000 for the covered period. If you have an employee that is making in excess of 100,000, you use 100 as the limit in your initial request. The non-payroll costs include the interest payments on mortgage that is incurred prior to February 15th, no prepayments or no payments on principal. It can be the rent payments, and then the business utility payments, including that are defined as electricity, gas, water, transportation, telephone, or internet access. And these have to have been in service prior to February 15th. Next slide, Jim. And this goes through, again, all of these qualified and excluded costs. So again, the excluded costs are your payroll taxes, your railroad retirement taxes, and income taxes. Any compensation on an employee whose principal place of residence is outside of the United States, compensation in excess of $100,000, and then any qualified sick leave that's covered under the Families First Coronavirus Response Act. The IRS has specific tax credits listed there, and you can visit our COVID-19 Business Resource Center on our website for additional information to help you understand the difference between those, or connect with one of our advisors to go through the nuances with that specific aspect. Go to the next slide, Jim. So the amount you qualified, again, was based on your sum of qualified payroll costs minus any excluded payroll costs. And then you determined your loan amount by timesing that by 2.5. And that would be your maximum loan amount. You can go to the next slide, Jim. So as we look at the allowed uses, again, it's the payroll that I went through. It is your utilities. There is no prepayment on mortgage interest and on the principal. And all of the debts, these must have been in place prior to February 15th, not incurred, but in place. The 75-25 rule, so that is 75% of the loan must be spent on the payroll costs, and only 25% can be spent on the non-payroll costs. And that's if you want to achieve the maximum forgiveness. Forgiveness will be reduced if the borrowers reduce wages by more than 25% of what an employee's prior year compensation was. So that means you can reduce an employee down to 3/4 of what they were making in the prior period. And then that's also in line with the 75% of the total loan needs to be spent on the payroll. So there's two places that 75% comes into play. Forgiveness will also be reduced if the borrower reduces their full-time equivalent count, unless they are restored by June 30th, 2020. We can go to the next one, Jim. So payroll costs, what is new and clarified? I think I'll turn this over to Valeria.
Sure. Good morning, everyone. So there's some important things here to note as to some clarifications. So one of them was, when can I use the funds for? And it has been further clarified that those costs must be paid or incurred during the 8 consecutive weeks following the disbursement of the loan. So as you get the money from the bank for the loan, the 8-week clock starts counting. And that's referred to as a covered period for payroll. Now, one adjustment that was made for administrative convenience is to use an alternative payroll cover period. This basically allows small businesses to select the first day of the first payroll cycle after they get the money to count the 8 weeks, the 8 consecutive weeks for payroll purposes only. This doesn't apply for your utilities or your other things, but for payroll purposes, you can move that slightly a few days to coincide with your actual payroll period. So there's 2 definitions that have also been further clarified. One of them is when a payroll cost is considered paid versus incurred, because both are covered. So a payroll cost is paid when you actually distribute the paychecks, or if you do direct deposit when you start that electronic transaction. Payroll cost is incurred during your last pay period, or whether it's the covered or alternative payroll period, if it's paid on or before the next regular payroll date or within the payroll periods, so that it is eligible for forgiveness. So basically, in general, payroll costs are incurred when the employee earns the pay, which is the day that he works or she works or would have worked under normal circumstances. If we can go on to the next slide. Okay. So, so how is the potential forgiveness reduced based on the reduction of full-time equivalent employees? So the first good thing that was done here was clarify what was going to be considered as a full-time equivalency. So the SBA, together with Treasury, decided that the average work week for most Americans for a full-time job is for 40 hours a week. There were discussions as to whether it was going to be 30 hours, 40 hours. They settled on the 40 hours. So that provides us with some clarity. And there are 2 ways where you can choose to calculate your full-time equivalency. So you can choose one of 2. And that's going to depend on your individual circumstances. So if you're not entirely sure, again, you may want to consult with one of our advisors. So you can choose it as a quotient of 1, right? So a full-time employee, 40 hours is 1 full-time equivalent. Now, it doesn't matter whether they work 45 hours, 48 hours, 50 hours, about 40 hours is 1 full-time equivalent. So if you have somebody that's working 30 hours, you could calculate it as a quotient and say, okay, 30 hours a week will be 0.75 of a full-time equivalent. The other choice is to count each part-time employee, regardless of how many hours they work, as 0.5 of a full-time equivalent, right? So half. So whichever one you choose, what you want to make sure is that you keep it consistent across your workforce. Can we go on the next one? Thank you. So the next step is to look at a reference period. So when you initially applied, depending on whether you had been in business last year, you had started just this year and were in business on February 15th, or you were a seasonal employer, you had different choices to have a reference period. So those reference periods will still apply as you move on to calculating the forgiveness and comparing what your full-time equivalent employee count was during a prior period and now. So you can choose either February 15th to June 30th of 2019, or January 1st of this year to the end of February. And if you are a seasonal employer, because they understand that your payroll count may increase at certain parts of the year. So you can either choose one of the 2 methods above, or you can look at a consecutive 12-week period anytime between May 1st and September 15th of 2019. So just pick one 12-week period. Hopefully, you're matching the same 12-week period that you chose to calculate your initial request. And so you can match it closely to what you actually requested. And then what you would do is calculate the reduction based on full-time equivalents, and that will be the same percentage. The reduction is the same percentage of full-time employees reduced. So an example, if as a small business, let's say you had 10 full-time employees during the reference period that you picked and reduced it to 8 full-time equivalent employees, then your decline in the workforce will be 20%. So only 80% will be eligible for forgiveness. Thanks, Tim. So how does it work when we are looking at wages instead? So in general, and Matt was mentioning this before, a reduction in an employee's salary or wages in excess of 25% will result in a reduction in the forgiveness amount. So there's a reference period that is specifically included for the calculation in the reduction of wages. So they will be looking at the period between January 1st and March 31st of this year. So for any new employee, in 2020, and each existing employee that wasn't paid more than the $100,000 limit we were mentioning before, you will have to reduce the forgiveness amount by the total dollar amount of the salary or wage reductions that you made that are above that 25% when you compare it to the January through March period. So what's important to know is that, again, that reduction is based on a per employee basis, not the aggregate. So if you reduced it for one employee and you didn't reduce it for another, it's not going to be a percentage, right? It's just the dollar amount of what you reduced above 25% for that one employee. So to consider an example, so if you had an employee that was getting paid $1,000 a week, to just have some easy numbers, right? Before the disruption. And you reduced it from 1,000 to 700 a week. So as you didn't reduce the hours, right? The employee continued working the same amount of hours. So they don't have a change in their full-time equivalent status. They're still working 40 hours. So the first 25%, right, would be exempted from that reduction, right? Because you're allowed to reduce wages up to 75%. So out of those 1,000, you changed to 700, right? You had a difference of 300. So those first 250 will be exempted for the reduction because they fall within that maximal allowable 25% reduction. But you have an additional $50 on top of that 25%. So what you would do is multiply those $50 a week that you reduced times the 8 weeks, and that will tell you have $400 that will be reduced from your potential forgiveness. So just to give a quick example with some relatively easy numbers. Now, again, another important clarification that was done here is like, what if you cut somebody's hours, and by cutting their hours, you're reducing their wages? Do you get penalized twice, right? So there was a clarification here specifically designed to avoid a double penalty. So the salary and wage reduction applies only to the portion of the decrease that is not related to your full-time equivalent reduction. So if you reduce the hours, which means they experience a wage reduction and a full-time equivalent reduction, you only count the full-time equivalent reduction and not the salary or wage reduction for that particular employee. So you're not getting penalized twice. And so what can we do to avoid some of these reductions? So again, there are no penalties if you restore the full-time equivalent count and the salary and wages to the levels of the reference period by June 30th of this year. And here's an important thing. There are no penalties if you offered a laid-off employee the job back, same hours, same wages, and they refuse it for whatever reason. There are some caveats to this. So there are some things that you have to comply with in order for you to be able to exempt this particular employee from your calculations. So you have to have a written offer to rehire that employee. You have to record that the employee rejected the offer. Of course, the offer again has to be for the same salary or wages and the same hours that they were earning prior to the separation or the reduction in hours. You have to maintain very good records about the offer and the rejection, and you are required to inform the Department of Labor that the employee rejected the offer of unemployment within a 30-day window from the rejection. Now, of course, under the circumstances that we're living in, some employees may have perfectly good reasons for not wanting to come back. They may have people in their family that are vulnerable. They may be vulnerable themselves. In order for you to qualify for the forgiveness, you have to record it and report it. That doesn't mean that the employee can't argue that with the Department of Labor and explain what their particular situation is. And it doesn't mean that they will automatically be disqualified for unemployment benefits. This is just your portion to comply with. And it's important for you to be able to explain to your employees that it doesn't automatically mean that they'll be disqualified if they have good cause from obtaining unemployment. Did you want to go over this ones, Matt?
Sure, I can jump in. So moving forward, so, this has been as Valeria has gone through, there have been a lot of changes, and this has been a moving, shifting environment. I think, Jim reminded us that when they first announced the program, they changed the interest rate overnight in terms of the loan from the night before they opened the loan applications back on April 3rd. So as we move forward, Connecticut Small Business Development Center is here to help you. Some of you might have seen this morning in headlines that Congress, the House of Representatives, passed some potential changes again to the Paycheck Protection Program. It's only been passed by the House, and so we're waiting to see what the Senate would pass or might pass. Nothing is, certain for sure, but there could be additional changes by the time it comes time for you to apply. So we're here to help you, and one of the ways that we can help is that we have a Paycheck Protection Program loan forgiveness calculator, and this is one of the tools that an advisor can use to help you make sure that you're tracking and documenting all of your expenses and showing what is qualified so that you can figure out what your forgiveness is going to be. We can keep moving forward, Jim. And, as always, the Connecticut Small Business Development Center is here to help you in good times and in bad as you move forward. So whether it's paycheck protection forgiveness right now and your application, if it's looking for other opportunities for financing moving forward, or other strategies around operations, reorganization, assistance with the HR side of things, customer acquisition, our advisors are here, and it's a free service. So there is really no risk to working with us, and it's completely confidential. And we also have a COVID-19 Business Resource Center. This is aggregating information from the federal government on these programs, as well as the Reopen Connecticut efforts. As each industry guide is made available through the state, we're aggregating all of this information and make it available to you on our website. So I think now we have several questions in the queue. So if Joanna or Johanna, do you want to moderate those? Or?
I'll take the ones in the Q&A portion and in the chat, Matt, and I know Johanna, I believe, has some coming into her privately through email and through a private chat.
Thanks,
So
Jeff.
some of these that came in before your remarks. First of all, great job. Thank you all so much for providing this critical content here. A lot of these came in originally at the start of the presentation, so they may have been covered, but I want to make sure we don't leave anything on the table, so I'll still go through them one at a time as long as everybody's comfortable with that, even if it is a bit redundant through the answers.
I think
So the
that makes
first one
sense.
is, thank you, Matt. First one is, if I got a $10,000 PPP and did everything correct and received 100% forgiveness, but I got a $2,000 EIDL advance that has to be subtracted from my forgivable amount, does that mean I don't have to pay back $8K, but I do have to pay back the $2K?
So at the moment, yes. The guidelines are use slightly vague language in that it says, if applicable, the SBA will deduct the EIDL advance from the total. So there's no further clarification on what if applicable means, but in what they show as example calculations at the moment, that is what they are showing, that the EIDL advances will be deducted from the total forgiveness amount of the PPP.
Okay, Jim, Matt, do you want to amplify that answer at all, or should we move on? Jim, I believe you're still muted.
Here we go.
Okay.
There we go. Yeah, that's one of the things we've been dealing with since these programs started. The EIDL, of course, came in weeks before the CARES Act, which created the PPP program. And the conditions of the EIDL loan back then were that the advance was a forgivable portion of the loan. PPP was created afterwards, and they apparently in Congress then thought that they should do it a little differently and not allow you to double dip on forgivable portions of any of these programs. Nonetheless, that is going to probably need some clarification, and to make it clarified, it's got to come through Congress, just like the current legislation that passed yesterday, which if it goes through and is reconciled with the Senate and signed by the president, would extend the 8-week period up to as long as 24 weeks. The Senate bill that's currently in place, I think, has a 16-week limit on it. There does, in this case, appear to be some bipartisan support for some kinds of modifications. They recognize that the entire program was a little bit too restrictive, and they were a little too optimistic about how quickly the virus would pass out of our systems. But again, the rules in place that Valeria described are the ones that are the only ones we can offer firm advice on until they change it yet again.
Understood. Thank you, Valeria. Thank you, Jim. Moving on here, and we have a number of them coming in fast and furious. So with the quote, not more than 25% reduction in wages, end quote, that means wages per hour, not gross wages per week. So there's an example that she provides. Oh, it's moving on me a little bit. Sorry about that. So I hire them back at the same hourly rate or more, I am okay, correct? Did that come through okay?
Can you repeat that?
Sure. Okay. So she's basically providing an example to set up the question. With the quote, not more than 25% reduction in wages, that means wages per hour, not gross wages per week. So I hire them back at the same hourly rate or more, I am okay, correct?
No, it's your total wages. It's wages per week. It is not dependent on the wages per hour. So basically, you're going to experience one of two when you are reducing wages, right? You're either reducing the amount of hours that somebody gets, so they get less money in a week. If you're reducing the amount of hours that they get, basically what you will be changing is their full-time equivalency status, right? So if you're cutting them from 45 to 40, that's fine. If you're cutting them from 50 to 40, that's fine. But if you're going anywhere below 40, you are reducing their full-time equivalency count. So you will get a penalty for reducing your full-time equivalency count. If you are reducing the amount of money that they get per hour without changing the amount of hours that they work in a week, as long as it's not more than 25% of what they were getting before, and of course, still within legal wage limits, right? Then, you should be okay as long as it stays within that 25%. If you reduce it by 30%, then that 5% becomes repayable and so on. Hope that helps clarify that. I don't know if you want to add anything, Jim, to
Oh, I think you beat it to death.
that.
That was a good answer. Thank you very much. Okay, moving on. If I hired back the same FTE of employees and kept them through the 8 weeks, but my business is not open at the end of the 8 weeks, so I have to furlough them again, am I still eligible for the 100% forgiveness because I kept the same FTE during the 8-week period?
Technically, yes.
Okay, technically, yes. Very good. All right, moving on here. I'm still in the Q&A portal, and then we'll move on to the chat portal. And I believe Johanna has some as well. So this is kind of a two-part question. So you continue to say that you can't prepay interest. And can we safely assume that we can still prepay utilities and rent?
Yes and no. So you can only basically pay utilities that you used during that 8-week period. So let's say, you pay your May bill, utility bill, you pay your June utility bill, and then you have your next due bill for utilities as July 10th, right? It's your date of your next bill. You can use the portion of the July bill that was part of the June expenses for utilities, right? So, but you can't use future dates. You can't prepay utilities either. You can use, if it falls within the 8-week covered period, then you can use the portion of the July dated bill, as long as you pay it when it's due. You can take the portion of the July 10 bill that corresponds to the 8-week period and use that as a part of forgiveness. But you can't prepay the entire July bill with it.
Yeah, they've done they don't allow an alternate period for utilities or for rent or other things like they have allowed for adjusting to a payroll period, so that you can move if your payroll period didn't start until 8 days after you got the loan because you're on a biweekly payroll period, you can select that alternative period for those purposes, but you cannot for rent, utilities, and interest.
Okay, thanks so much. Back to the portal here. And again, forgive me if they're a bit redundant, but I think they're all very important and should be addressed. So next one, can you give an example of the reduction in the forgiveness if the FTEs go down because an employee refuses to come back in? I think this was covered in one of the slides, but if you can deliver that answer again, we'd appreciate it.
Yeah, absolutely. So as long as you have it well documented, you are able to exclude that employee from your account for forgiveness purposes. Again, if somebody refuses to come back, you have to have a written offer that you sent them. You have to record their refusal, however they provided to you. You have to record, the day that the person told you they were not coming back. And then you have to report that to the Connecticut Department of Labor, the unemployment department, so that they can figure out the details, with unemployment from there. And as I said, some people may have very valid reasons for not wanting to come back, but it's still required by the program that you report it, and then the employee can figure out the details with the Department of Labor if an exception applies to them for them to continue collecting unemployment, for example.
Now, one of the questions that's also come up has to do with an employee who, for whatever reason, refuses to respond to your written offer. And so they don't call you, they don't send you anything back by email or in writing or any other way. What we're suggesting is that your offer, make sure that your written offer includes a day and time to report back to work. so that you can record the fact that they don't show up as their refusal to come in.
Right.
And that then can be your documentation, is that they failed to appear, failed to respond, and a failure to appear can be your refusal to come back.
Understood. Thank you. How does the 75% reduction per employee work with changes in the actual employee? Is it by name?
In the forgiveness application itself, there is a worksheet that asks you to list your employees one by one with an identifier. So it is, it's not by name, but that allows them to qualify how many employees you had and what their wages were attached to them, because you're providing, either payroll documentation to show that. So if you happen to replace that employee for any reason, let's say, you offered an employee to come back, they didn't want to come back, but you needed that position, so you brought somebody in their place and you're paying them at least 75% of the corresponding wages that you were paying the other employee, you should be okay. So they're not going to be looking at, did you swap the employee? They're going to be looking at it like that, but they're wanting to evaluate your full-time equivalent count and your wage as compared to other periods.
Okay, very good. Thank you. It says at least 75% of the loan must be paid to the employee. What is the max that can be paid to the employee?
100%.
100%.
As long as those are qualified payroll expenses. So as it falls within qualified expenses, you can use 100% of it for payroll.
Yeah, this is a common confusion. The 75% is a floor number below which, if you don't use it for payroll, then you begin to lose some of your forgiveness. And the 25% on utilities and rent and other similar expenses that qualify is a cap above which you begin to lose some forgiveness.
The only other piece is that the max annual compensation for an individual is $100,000.
Right. That's why we're talking about those allowable uses.
Yeah, and be careful about the 100,000. The 100,000 is not in the 8-week period. It's the annual equivalent of
annualized that amount, right?
Right. Which in the 8-week period, that's about 15,500 roughly in that 8-week period.
Right.
Understood. Thanks so much. Great answers there. Does business revenue generated during the covered period play a role in forgiveness?
No.
Nope.
Short and sweet. Okay, moving on. I have an employee I hired a week before my business shut down. He worked for a week. I brought him back 3 weeks ago, and I don't think he's going to work out. If I fire him for poor performance and don't replace him, does that count in the FTE reduction exceptions? The language says fired for cause. Is poor performance considered cause?
Poor performance is considered cause. And I believe if that new employee came in after the base period, while they could be counted in your FTEs, they don't compare to the base period beforehand, because that job didn't exist back when you had it in your base period. So you're probably still just fine.
Right. If you're looking at 2019, it wouldn't make a difference.
Right. So we've had quite a number of our clients have similar situations where people have either had to leave or have taken other employment in some cases and had to be replaced. But so for everything but the individual employee salary reduction calculation, it's really just the number of positions and heads independent of the exact name of the employee.
Okay, very good. Thank you. Moving on. If employees typically receive overtime, should we continue to pay at this pay level regardless of actual hours worked? I.e., our employees typically are paid for 45 hours per week, giving them 5 hours a week at time and a half. We may not have enough business to actually work at that level during the covered period.
I think you can safely, if you have enough money to do it and you want to do it just to be a nice a nice employer, okay, fine. But I think you've got to make some fiscal decisions about that. If you have to reduce them from 45 to 40, indeed, that still does not impact your FTEs and doesn't count as a salary reduction. So you may still just want to pay them their 40 hours without the overtime until such time as you have business to come back. You'd probably have done that anyway if business was off for any other reason other than the pandemic. By the same token, however, if you wind up having to reduce them down to 30 hours from 45, now you're at that 0.75 FTE threshold. You still don't get a penalty at that point. But the moment you go below that,
Actually, I'm sorry, Jim. The FTE has to be 100%. The wages can be 75%, but the FTE has to be 100%.
Right. Got it.
Sorry. I don't want to confuse anyone.
Okay. Thank you very much. Okay, moving on. I understood prepayments was okay. Is that a correction, as examples have had whatever was paid in cash? So another clarifying question on prepayments.
So as far as we understand, the guidance says that everything that is allowed in the forgiveness is expenses incurred or paid during the 8-week period following the disbursement of the loan. So I'm not entirely sure what this particular person means by prepayments, but you can't apply payments retroactively, and you can't prepay expenses that you haven't incurred yet.
Okay, and a follow-up just came in from the same individual. Can it be higher than 100% within the total wages?
if I interpret that right, if for example, if somebody wound up putting people on overtime that normally didn't have overtime, and you spent more money than you historically would have spent, as long as you meet the 100% level out of your base period and so forth, you should be fine. But the rest of it's coming out of your own pockets. You're not getting an extra loan that would forgive more than you got originally.
Okay, a little bit of a different question here. I paid half my April rent prior to receiving PPP. Can I pay the other half of April rent with PPP money?
If April is the period in which your 8-week period started, because that rent payment would have to be for that covered period, yes, you can. In terms of the forgiveness, then you just have to be paying attention to that only 25% of your total loan can be spent on, rent, those non-payroll expenses in terms of maximizing the forgiveness. Anything I left out there?
It's primarily, you judge it. If you got your PPP loan, say on April 15th or April 20th, you probably could do that. If you didn't get it until May, you cannot.
Great, thank you. Important clarifications there. What if you don't use the full amount by the end of the covered period? Can you simply apply for forgiveness for the amount used?
Yes, there's no prepayment penalty. So you can return what you have left, and then you're just applying for forgiveness based on what you expended.
And again, as long as it complies with that at least minimum 75-25 rule, right?
The 75-25 would now be calculated based on the amount you use, not the total original amount.
Right.
Okay, thank you all. I'd like to apply to the CTDOL shared work program. Can I use PPP money to pay a reduced schedule to my employees and have it be partially forgiven?
No.
Okay, the answer is no. Moving on. Any change to benefit the sole proprietor to pay themselves more than the prior year? A lot of my clients that are owners are working harder and trying to see if they can pay themselves more than last year. And does that change if a partnership, and does that change if it is a partnership or an S corp?
So basically, PPP is designed to replace wages that you lost compared to what it would have been in prior years. So it's not designed to pay you more, whether you are self-employed or not. You're calculating as a self-employed individual based on your net income from your prior year, and you know, the 100% of what you requested is based on that. You can't pay yourself more than that.
Okay, understood. Moving from Q&A into the chat portal, can an employer pay an employee extra pay, for example, increase wages or bonus for working more hours during the 8 weeks and include it in the forgiven part? Is there any penalty for laying off an employee or reducing hours right after the 8-week period? So a two-part question.
So bonuses, anything that is a compensation or an equivalent of cash compensation is allowed as part of the use of the payroll funds. What you have to be careful with the second part of the question about a penalty for laying off an employee or reducing hours right after the 8-week period, that's going to depend a little bit on your payroll period, right? And whether you chose the straight 8 weeks or the alternative covered period, because you may have hours that were earned by an employee that you haven't paid yet, that are earned within that 8-week period, but won't be paid until the next paycheck. So you want to make sure that at least through that next paycheck, you keep things as they were. And then after that, if you have to lay them off because you still don't have enough business or reduce hours, you should be all right.
Okay, very good. This last one here in the chat portal is also kind of a two-part question. First of all, is a cell phone bill considered telephone, in quotes, which I imagine is an eligible expense through the guidelines? And as a follow-up, does the bank that distributed the PPP funds recommend the forgiveness to the SBA if all the terms are met? So I guess that's a mechanical question. Who actually is kind of the final decider on the forgiveness? I imagine it's SBA, but do they follow the bank's recommendations?
Yeah, as we understand it right now, of course, you do apply for forgiveness back to the bank. The bank has 60 days to approve that application and submit that request for SBA to pay them back the money rather than you, the borrower, paying back the money. And on the cell phone that is in the business name and billed to the business does count as a utility.
All right, important distinction there. One more that came into the Q&A just now. Do we as employers pay taxes on this loan when it is forgiven?
That's an open question because you're not paying so much tax on the loan. What IRS has ruled after the legislation came out is that you can't deduct the expenses that you used the loan to pay for if it was forgiven. So you wouldn't be able to deduct the payroll that you paid as part of your cost of doing business for this year's taxes. Now, that got a lot of people in Congress a little bit upset, but we have not yet seen anything in proposed legislation to correct that. The IRS, unfortunately, was on solid ground because of the way the tax code has been written in prior years by Congress. So that if you got a grant for something and the forgivable loan is considered a grant under the tax code, then you can't deduct the expenses that the grant paid for because that's considered double dipping on your income tax. So get to your local congressman and senator and ask them to beat the IRS up through new legislation, which allows an exception for the tax code to do that.
Great, thank you, Jim. And Valeria, there is a request for you to restate your answer about laying off after the 8-week period. As I understood it, if you don't have the resources and you follow the guidelines through the 8-week period, then you're in compliance. But why don't you take that one?
Sure. Yeah. The only caveat that I was adding there is that if you are, for example, on a biweekly pay period and you choose your alternative covered period, you may have wages that were earned during that 8-week period that have not been paid yet because you pay on a bi-weekly basis, right? So if one of those weeks falls in the covered in your cover period and the other week falls in the outside of that 8-week period, right? You want to make sure that what falls within that 8-week period gets paid and properly documented, even if it is on the next paycheck. And then after you do that, if you have to reduce wages or hours or lay off people, you should be all right.
Okay, so from my view here, I believe we've exhausted all of the questions in Q&A and in chat. I'll kick it back to Johanna, have her confirm that and see if she has any questions on her end.
You know, I did get one that came into the email, and I think you guys have kind of covered this, but it's good to always ask these questions. We own a pizzeria. We have some high school students and young adults whose parents have decided they didn't want them to work through this time. We replaced them with new employees, and our payroll has actually increased drastically, as my husband is not able to work through COVID. Will this negatively affect us?
Biggest problem now is going to be whether or not you can make any money with a higher payroll with whatever sales you got going. To the extent that you know, use whatever payroll protection money you've got to pay those higher wages for the replacement employees, you know, at least reduces some of that impact in the short term. But ultimately, you have to then make some business decisions about how you're going to run the business with what level of employees and what level of service.
Great, thank you. If there's any more questions, we have a couple more minutes. Please do so in the chat or in the question and answer. For those of you on the phone, maybe if you came in late, if you do have a question, you could always send it to myself, and that's Johanna at middlesexchamber.com, Johanna at middlesexchamber.com. We'll wait about 2 more minutes. Got a nice shout out, guys. Thank you all.
It's our pleasure. Johanna and Jeff, thank you so much for working with us. Oh, I did see a question that came in terms of where we can get the forgiveness application. And Valeria, you're muted. It's not on our website at the moment that I see. So
yeah, so there's 2 parts to this. So it's publicly available, but you can't apply until your bank has put it in their system, because it has to go through your bank. So my first go-to will be the bank. However, based on the fact that there are some things that are in the process of changing, unless you know that right now you've met all the requirements to get your loan 100% forgiven, I would not rush to apply, right? If you're sure you kept your employee headcount, you paid, all your expenses appropriately, and you met all the guidelines established, and you're like, I'm good to go, I'm going to get 100%. You can go ahead as soon as your bank releases the application, makes it available to you, and they will be your first point of contact for the application process itself. However, again, if you're not sure about some of these areas and you're still looking for some flexibility, I would honestly just wait and see what happens as these things are moving through Congress, and they might provide some additional flexibility. Something's going to change, right? We don't know exactly what yet, because there's a difference between what the House is proposing, what the Senate is proposing, but there seems to be an agreement on both sides that something needs to be modified. So if you're not 100% sure that you will get all your forgiveness as you want it, I would just wait a little longer before rushing to submit the application. There is no deadline right now for you to submit the forgiveness application. The only timeline that we have is an expiration date in the application form itself of October, and no additional guidance has been provided as to, by when you need to submit it. So keep your records, make sure that you document everything. If you've never been very good at keeping records, this is the time to make that change. And make sure that you're keeping good records on everything, because your ability to keep good records is gonna help you in the whole forgiveness process. So make sure you're doing that, and you can wait a little bit and see if anything's gonna change that could make things a little easier on you as it's move forward.
Yeah, and the SBA is allowing the banks to create their own forgiveness application form, just as they did for the application for the loan in the first place. So for many banks, this will be an online application versus a paper form. So keep an eye out. You will go through the bank from which you got your loan. And there currently, as Valeria said, there is no date after the end of the 8-week period, no deadline date set yet for you to file for the forgiveness. Once that date is determined, we'll get that up on our website certainly, and it'll be made pretty widely public. Your bank will be letting you know as well.
I have a couple more here, one that came in privately and one that went to all panelists that you may have seen. If you have complied with the 75% payroll, can you pay bonuses to meet the 25% other cost to employees? And should you do it weekly or at the end of the 8-week period?
Well, here again, I think there's some confusion about the 75-25. The 75% for payroll is a floor below which you start to lose forgiveness. So if you've paid 95% of the total funds to employees over the 8-week period for salary, and you perhaps have offered a hazard pay bonus or something like that because they came in and helped sanitize the place and so forth, you're perfectly fine. Your only problem is if you drop below 75% in payroll-related expenses, then you begin to lose some of your forgiveness.
Okay, and the final one I have here on my end is, have you heard anything about the reopening of the EIDL portal? We know that when there was a second round of funding, that everything that was currently in the portal used up all of that money, that second round, and it has not reopened to our knowledge. Do you believe or have you heard anything to that effect of the reopening of the EIDL application portal?
The only thing we know about the EIDL right now is it's open only to agricultural businesses for new applications. The other significant change that they made, because they were so overwhelmed with applications, is that they, in the middle of things, unilaterally reduced the maximum loan available to $150,000. Now, there's quite a few folks that we've talked to, including a number of my clients, who came up being quite surprised all of a sudden when they only were offered 150 when they were expecting 300,000 or $500,000 or something even more, because they tightened up the maximum loan amount only to be able to spread it across the applications coming in.
Matt, did you have something else?
Well, I was going to say the only thing additional, in terms of EIDL would be to pay attention to what Congress is looking at in terms of a next round. I believe that there was additional funding towards EIDL that was in the bill that the House passed. But again, we have to see if the Senate is going to take that up. So write to your representatives.
Fair point. That's it from this end. Johanna, anything come into email? Anything else?
No, we're all good. Thank you guys very much. What a fantastic session. We truly appreciate this. I'm sure we'll have you back at some point. Did something else just pop in?
We know things will change, so we'll probably be back.
We did get another question. If part of the loan is based on profit, owner's portion, or draw, can an owner pay themselves by a draw as part of the 75% payroll?
If it's part of their normal payroll practice, historically, the answer is yes.
Yeah, I mean, if we're talking about, net profit, if we're saying if the loan is based on profit, what I'm assuming is that this was a Schedule C calculation and the request was based on net profit. And yes, the owner can pay himself, 100% of their the amount towards wages, or they can choose to, you know, if they happen to have an office, like if you have a lawyer or an accountant that has an office of their own outside of the home and they have utilities rent, they can use the 25% up to 25% on those things and then pay themselves the rest on payroll as a draw.
Excellent.
Again,
Again-
as long as that doesn't exceed the annualized rate of 100,000 a year.
Right.
Annualized. Very well clear. All right. Thanks again, guys. Have a great weekend. Thank you all for joining us. We will be putting this on our website. And I will be sending out to all the attendees the email addresses so you can reach out with any additional questions. You guys, great job as always. Thank you so much. We look forward to seeing you again when another round comes out and some more questions are there. But for now, everybody have a great weekend and stay healthy.
Thank you for
Thank you.
having us.
Our pleasure.
Stay well.
Thanks, everyone. Great work.